Joining me now with more on the markets from Dublin, Ohio is Ed Siddell. He's the CEO and Chief Financial Advisor at EGSI Financial. Ed, great to have you on the show this morning. What do you make of this market?
Yeah, thanks for having me. With the pause for the next 90 days, I think we're going to continue to see a lot of volatility. If we look at the VIX being at the level that it is, we're going to continue to see, 2 to 3% swings, on a daily basis.
Interesting. What does that mean for investors? How should they be navigating this particular environment?
They should really just hang on. If they have money sitting on the sidelines right now, I mean, this is really an opportunity to buy. If we look at the PE ratio, it is significantly lower now than it was even at the beginning of the year. So this is really a buying opportunity. We tell everyone it's almost like investing in a 401k. You keep your dollar cost average all the way down and all the way back up. And so then you're going to be able to recover any losses that you had on paper that much quicker. And really the only time that you lose money is when you sell. So if you're already invested, now's the time really just to sit tight and be patient, because cooler heads are going to prevail.
Ed, my question to you here is, if people are in a position to buy in this market, as you referenced earlier, are there particular stocks or even sectors or indexes that look attractive to you at these levels?
Yeah, absolutely. I believe it or not, even though it's the earnings season for financials, I really like financial. I know that they've been giving a lot of warnings to hedge their bets for recessionary fears, to lower expectations, but I still believe that financials are going to be strong this year, especially if rates continue to lower. Especially when we look at some of the smaller and regional banks. I really like energy and industrials, manufacturing, as that continues to come back. And really, believe it or not, technology. There's a lot of technology out there, especially in the AI sector, that there's so many good deals right now all the way across the board. It really is a buyer's market for the first time in years.
Interesting. Ed, a question to you is, what do you make of these bank earnings? Certainly, they exceeded expectations. That might not have been a surprise. Those are backward-looking figures, though, and we did get some commentary on the economy moving forward.
We thought that the earnings, they were going to at least meet expectations. We did not. We were actually shocked that they blew it out of the water. JP Morgan Chase, Morgan Stanley, Wells Fargo. And I think we're going to continue to see that going forward. What we're also seeing right now is they are really hedging their bets, expressing recessionary fears, although Goldman Sachs backed off of that. I think a lot of things are really going to be contingent upon these next 90 days. The trade talks, the tariffs, especially the tariff volatility as it relates to China. But we're starting to see a lot more countries come to the table and willing to negotiate. So the market is really looking for any kind of good move. We saw it on Monday when there was a leak, maybe even a trial balloon for 30 seconds, where the market swung, that there was going to be a possible pause for 90 days. The market went from being 14 down to over 800 up. And then within 30 seconds, once they said that was a rumor, then it went back down again. And then once they did put a pause on tariffs, the market went crazy. So really, the consumers, investors, they're really just looking for any type of good news. So these next 90 days are going to be paramount to the market.
These next 90 days will be very important. We had heard, of course, from the White House and members of the president's cabinet that 90 days, of course, is the tariff pause for some particular countries. But also the Treasury Secretary had said he thinks some of these deals can be negotiated by June, within 90 days or so. I am curious to get your take, Ed, on the inflation data that we got today and yesterday, because it certainly came in less than expected. And I think if we were maybe not in this environment, that would be a good news, right? Because we had seen that inflation had been so sticky. Is there any correlation to make there between that slowdown in inflation with a potential broader slowdown?
It could be. We're seeing really demand slow down all the way across the board for goods. But we're also seeing a slowdown because of energy costs going down and food costs going down. And remember, energy, diesel fuel, that's really what powers the economy. So if we can continue to lower energy prices That's going to lower inflation and, make living for everyday America that much cheaper. So we really have to look at it on both sides of the coin. My biggest fear going forward really is the tariffs. And then also being able to pass this reconciliation bill.
Yeah.
I think we need to pass the reconciliation bill and get deregulation going forward. And that's really going to strengthen the economy, even as the cost of goods and services may increase a little bit.
Ed Siddell, he's the CEO and Chief Financial Advisor at EGSI. Ed, thanks so much for joining this morning.
Absolutely. Thanks for having me.